Chapter 3, Trim Your Taxes. Paying tax comes with earning money. We all get that. Entering retirement is a matter of understanding how much money you can retire with, and a lot has to do with your tax picture. As I said earlier, many people are so stuck on how much is withheld from their paycheck for taxes or pension and the like while they are working that they don't realize how this will change during retirement. It is a much rosier picture than most people imagine, so let me paint a picture for you. In Canada, the big picture about taxes starts with credits and a calculation called the basic amount of earnings. The basic amount for everyone of any age in 2023 is $15,000 in gross annual earnings before a penny of tax is owed. There is also a calculation called the age credit. If you are 65 or older, the age amount kicks in and you can add $8,396 to the basic amount of the $15,000. In other words, at that age, you can earn $23,396 per year before any tax is owed. Now we come to credits. Pension splitting. If you have a pension, you can get an annual $2,000 pension credit. This is where most people miss the boat. If one of you is working and the other is retired, you can do pension splitting. You share $2,000 with your spouse once a year, every year, and get a credit on your own tax forms, even if your spouse is still working. It's essentially a wash on taxes due. Another type of credit is available to you if you put money from your check into a retirement plan that acts as a deduction during your working years. The pre-tax money you put into the plan grows tax deferred, while your salary is taxed at a lower rate, since the gross salary is reduced by your contribution. You will pay tax on the money in the plan as you withdraw it, with the assumption that when you retire and withdraw, you will be in a lower tax bracket. This is a great incentive to participate in these programs. In case you are curious, when you get Canada Pension and Old Age Security benefits, the dollar amounts typically fall under the basic amount I mentioned, so there usually isn't any tax payable on the first $23,396 you receive. However, if you have other pensions and income, they will have to be added to your taxable income and will likely result in taxes payable. Related to pension splitting. If you are leaving an employer, you might consider a severance payment spread, dividing the severance amount over 2 years. It might be about timing. If you resign in May, you won't want to wait for the whole amount until the following January, or other aspects of your tax picture. Come and ask me. CPP Credit Sharing. What a lot of Canadians don't know is they can also apply to split money coming to them from CPP, the Canada Pension Plan. John worked for 40 years, making him eligible for the maximum CPP benefit of $1,200 per month. His wife, Mary, stayed home all those years and now is eligible for $400 in her own right. This brings the couple CPP to $1,600 monthly. Now John can apply to assign credits to Mary and vice versa. John assigns $800 of his CPP to Mary, and Mary assigns $800 to him, creating an even split of the $1,600 between them. This is called CPP Credit Sharing. Taxable income is reduced due to the splitting of credits. This is only eligible from age 60 and is based on the number of years of a common law partnership or marriage. DTC, the Disability Tax Credit. The DTC is for those with a health condition or disability who need ongoing health care or support. This is something you need to initiate with your physician or healthcare provider. The physician fills out a form providing the required details of your disability, and then you will submit the form to the government for an approval of this tax credit, which is $9,428 for 2023. Examples are a child or dependent with epilepsy or cystic fibrosis, or an adult child needing continuing care where the parent would apply for the DTC. Breathing trouble or hearing or incontinence issues also fall under this tax credit. Additional to the DTC, there is a caregiver amount. This is a fairly new change in Canadian tax law, about 3 years old. You might qualify as a dependent's caregiver if, as with several of my clients, you are caring for a disabled adult child in the home. You will need to be performing actions for the disabled individual. Real people. DTC and caregiver stipend. One client of mine had a 30-year-old disabled son living in the home with him and his wife. The son's income was less than $25,000, and their son was getting the disability tax credit. They applied, proving the dependency that they were their son's caregivers, and received an additional caregiver amount to help cover some of their costs. Real people, elder qualification. I had an 88-year-old client come in to complete his taxes. He had not been our client up until then. He clearly used and needed a hearing aid to hear anything at all and a cane to walk safely. It is unknown why his previous tax preparer did not ask questions about his disabilities and look into the DTC for him. It is also unclear why his physician did not mention this eligibility to his patients. Then again, they don't always. However, that was the case, so we not only applied for the DTC for the current tax year, but we applied for an adjustment extending back the allowed 10 years. The government allowed the back payments, which gave him a nice tax-free lump sum that year. It was well worth the few $100s the doctor charged to fill out the forms. Tax and your retirement income. What are the effects of taxation on your available retirement income? Most of my clients just don't know. Come and sit with me to find out. When you start taking RRSPs sooner rather than later, or vice versa, it will affect your tax picture. I see people retiring in their early 60s and taking their RRSPs. The latest age to take money out of the RRSP is age 71. I advise all my clients to think more strategically about taking this money out. In Canada, as an example of the tax impacted, when the husband dies, his RRSP amount rolls over to his surviving spouse tax-free. Fast forward to when his wife dies. Whatever money is left is all taxable. This could represent several $100,000 taxable dollars left in the account that their estate owes taxes on. You don't want this money to grow and accumulate too much and for too long. This is why I look at each client's tax picture very closely with them. Unlocking your LIRA. A LIRA, locked-in retirement account, is a special type of investment account for Canadians looking toward retirement. If during your working years you are contributing to a registered pension plan and leave that employer through a job change or retirement, the money in the RPP must be placed into a LIRA. The issue can be getting the money out of the LIRA. You can start withdrawing from or unlocking your LIRA between ages 55 to 71. I encourage my clients to start withdrawing sooner rather than later. Let's take an example of $100,000 just for simplicity. You have this accumulated in your LIRA and you are 55. You unlock 50% and then put $50,000 into an RRSP. So the money is accessible at any time. The money is all taxable, but you can access it any time. The other $50,000 goes into a LIF, Life Income Fund. You can withdraw only $3,500 or 7% per year of your income of the $50,000 from the LIF. That is not very much money. Here is why starting to withdraw it sooner is better. Take the same scenario I described above. Upon your death, your estate or your heirs would potentially have a very large tax bill on the lump sum remaining in your LIF. By taking the allowed amount starting, for example, at age 55, most people have withdrawn all the money by the time of their death. Real people, knowing if and when you can retire. A delightful longtime client of mine, Betty, is not the most organized person. She came in and told me the management at her workplace was pressuring her to retire. Then Betty commented that she couldn't afford to retire yet. I already knew this was not the case, so I said to her, I'll bet you're only working for a few extra bucks a month. We made an appointment to look through her pension statement so I could prove to her that she could indeed afford to retire. Betty was eligible for CPP. I demonstrated to her by the numbers that she was still going to work for only $50 extra per week. She was resisting retirement over a matter of $200 a month. On top of that, Betty paid $90 per month just to park where she went to work. Then I figured out how much she was spending a month in gas just to get to work. As it happened, she was going to work for free. Real people, save your health. Another client, Rafe, had decided to work for a couple more years. He likewise was working for only $200 a month. His rationale was that he hadn't worked for 30 years towards a full pension. Not true, actually. Rafe was approaching age 65. He already qualified for CPP and was just a couple of months away from qualifying for OAS. He was recently approved for the disability tax credit after learning about this tax credit from our initial meeting. In his mind, he thought working more would gain him a bigger pension. However, he had health issues, and his wife really hoped Rafe could afford to retire within the next couple of years. They both knew the job was beating up his health. His wife was thrilled when I calculated his retirement income, and he happily retired immediately. Between tax calculations and credits, people just don't know how to do the math to determine their needs, retirement income, and when they should retire. The disconnect in knowledge for most people is understanding the tax credits and basic amounts. Almost no one has to earn as much gross income in retirement as when they are working. I am quite happy to help them understand those numbers and all of the advantages and benefits. Real people. Time to leave the stress behind. I have a longtime acquaintance named Dorothy who was not initially a client. She often expressed her dislike of high-stress professional job at the hospital. She was worn out by the doom and gloom. When we spoke about it, you could plainly see she wanted out. Dorothy was approaching age 65 and had a hospital pension plan. Her longtime financial advisor was another friend of hers, but knowing me as well, she came in to see me for a second opinion on her ability to retire. I examined Dorothy's pension statements and plugged in all the numbers to demonstrate how her retirement would look with the basic amounts, credits, CPP, OAS, and her hospital pension. The bottom line showed her she was working for $44 per month. She was dumbfounded. It was quite comical to see. I imagined she would be swinging from a chandelier for days. That is how thrilled she was to leave her high-stress job. Seeing this kind of reaction is why I chose to work with this age group. It is a pleasure to show them that after decades of hard work and saving, they can indeed retire comfortably. The friend who was Dorothy's longtime financial advisor simply never ran those numbers for her. While she was prepared to work for 2 or more years, she immediately retired after submitting a month's notice. Interest income. What many Canadians do not know is that when they have interest income, they pay tax based on their marginal tax rate. A few examples of investments paying you interest income are traditional savings accounts, bonds, T-bills, GICs, or a guaranteed interest account, which is with an insurance carrier. The problem is most of these instruments over the past 20 or so years have only paid out between 1% to 2%. If we use a more generous number of 2% and assume you have $100,000 in a traditional savings account, you will receive a tax slip for $2,000. In other words, $2,000 is taxable, but not as a standalone amount. The $2,000 gets tacked on to your total income, and you are paying tax on that new amount of money based on your marginal tax rate. It is important to maximize your TFSAs. In the above example, maximizing the TFSA would be a great way to decrease or potentially eliminate your hefty tax bill. Real people, GIC and interest. How does that look? I prepared a tax return for a lady in her early 90s, and she had a tax slip for over $13,000 of interest income. She had never owed tax in the preceding 10 years and was quite upset when I explained to her that we had to include the $13,000 of income on her tax return. It appeared that she had a number of guaranteed investment certificates, all of which were renewable in the same year. She apparently was aware of this, but not of the tax consequences. I suggested she consider a laddering strategy. This is making sure your various GICs come up after one year, 2 years, 3 years, 4 years, and 5 years. The tax bill would look very different each year, advantageously so. I asked if she had a TFSA, and she said she had about $25,000 in one. The problem there is with the TFSA limit that year was $81,500 at the time I met with her. I suggested she speak with the bank or a financial advisor like me. Remember, I was just doing her taxes to make sure she has her TFSA maxed out. This would decrease the likelihood of an ugly tax bill in the future, like the one she had just received. Minimizing dividends. If you are planning for retirement and concerned that you may have your guaranteed income supplement or GIS clawed back in the future, consider minimizing the amount of dividends you take. If your income is going to be higher and you are concerned about your old age security being clawed back, you may likewise want to consider minimizing the amount of dividends you receive. In Canada, if you receive a dividend from a public corporation of $100, for example, you have to gross up that amount by 38%. So even though you receive just the $100, you have to report your total income as $138 on your tax return. You then get a tax credit of 15% or $15 based on that $100. However, for purposes of calculating your total income, it can drastically increase your total if you have received a lot of dividend income. This is something that should be taken into consideration when planning your retirement income sources. Capital gain spread. If you are considering a larger purchase, such as a vehicle, cottage, home, boat, etc., and you are going to be withdrawing money from a non-registered account, you may want to consider withdrawing the money over 2 tax years if you can. This is a strategy that mitigates the tax impact. Real people, splitting withdrawals over 2 tax years. Capital gains tax can take a chunk of your profits right out of your pocket. Spread out the capital gain and the taxes over 2 years. How does this look? I recently met with a gentleman named Samuel who is going to help his daughter Beth purchase a home after her divorce. I suggested Sam stagger his withdrawal over 2 tax years rather than pulling out the whole amount he was going to use at one time. When I met with Sam, it was October, and Beth was still in the preliminary stages of looking for a house. She was still a few months out from purchasing a property. I knew this might just be perfect for him. When I ran the tax liability numbers for Samuel in 2 scenarios, withdrawing it all now versus withdrawing it in 2 parts over 2 tax years, the benefit of the latter option was crystal clear to him. Luckily, he and Beth had plenty of time for the strategy. It was year-end, so he modified his original plan, withdrew a portion right then, and the remainder at the beginning of the new year. Now, obviously, depending on the size of your purchase and the time of year, this may not be possible. In more cases than you think, this could definitely save you a lot of money by spreading a capital gain over more than 1 tax year. Come see me and I'll run the numbers for you. Real people, monthly or 1 lump sum. A client of mine, Michael, is leaving his job. He has an option of taking a set amount of monthly pension payments for life or taking a lump sum amount from his pension with no further future payment due to him. The lump sum is called the CV or commuted value of his pension. This is another case where you need a professional to help you calculate the tax ramifications of taking the commuted value. It is also a matter of properly timing the decision. Michael could roll some of the CV into a LIRA and an RRSP account and take some as cash. I ran the numbers and showed him how this latter option, effective on January 1st, would save him $30,000 in taxes rather than retiring on December 15th of the previous year. Time your departure if it's voluntary resignation and save taxes. Talk to me about how to use this timing.